What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked #1 on Wall Street in the All-America Institutional Investor Research Survey.
Hello, Emily. Good to see you. Thanks for coming on the show. I'm really excited to talk to you today. It is April 2nd. We are 2 days into the quarter. And one of the things that you put together every quarter that I think is just absolutely phenomenal is the quarter recap. Sometimes I look at these and I'm amazed, like that happened in this quarter. That's how we got here.
I
Now-
feel every quarter I have that same response. It's amazing how much we can pack into a 3-month period. And it seems we see that every single quarter for the last several years. There's just been a lot of action to pack in there.
We do say that every quarter, and I think this one may take the cake. This was quite a quarter. So much happened. Where even to begin?
Where to begin? That's a great question. When we look back on the first quarter of this year, you could really boil down to 3 main themes of what sort of sums up the quarter. Obviously, there's a lot going on, but 3 real main points to break out. Think back to the beginning of this year, coming into 2026. We were coasting pretty well. Things were in a really good place as far as the economy goes. I would say that to start the year, we were in what we would consider to be a Goldilocks backdrop where things were really doing well. We were seeing a broadening in the market. Then in the midst of that, we did have an AI fear. We saw software down quite a bit. Max 7 got hit, but we did still see that broadening in the market. Small caps were up a lot. And then the third main thing, which obviously is just stolen the show recently, is the Iran conflict. And so I would break out the quarter into those 3 parts, and they're very distinct and they're all very different. And I think looking back at the way that we came into this year with that broadening story, I mean, we were really in a good place with PMIs that were rising finally after having been stagnant for 3 years. We saw mortgage rates at multi-year lows down below 6% finally. The 10-year yield was down below 4% finally. This was all happening basically February 27th, right before the conflict hit. And we were finally seeing housing activity picking up. So all of these things were coming together that we had been basically wanting to see and waiting for several years were finally starting to happen at the beginning of this year. And as a strategy team, we were basically as optimistic as we've been on the broadening story finally taking place because we did have all of these ingredients necessary to get that dynamic. And we were starting to see it happen. Certainly, we saw earnings expectations improving across sectors and size. And we saw small caps ripping. At one point earlier this year, the Russell 2000 was up 10%. S&P 500 had been a little bit less robust earlier this year, even when things were more in a Goldilocks state. And that's largely because of that second point that I mentioned, which is the AI fears, and the Max 7 really was weighing on the broader index. But we were finally seeing that rotation that we had been waiting for several years.
It was one of the cleanest macro backdrops we've seen in a long time. You had all of your traditional leading indicators pointing up. And it was definitely something, as you highlighted, that people have been hoping for a long time. But there were those cracks in the AI trade that did cause some angst during that rotation.
100%. And I would say, even though things were going pretty swimmingly for much of the market, people were not necessarily as optimistic or confident as you might think, given that so many people are so exposed to those mega cap AI plays, which had been getting hit pretty substantially. So it was an interesting dynamic, certainly, again, because you were seeing the equally weighted S&P 500 up a lot more than the cap weighted. You were seeing small caps up way more than large caps. And typically that is a backdrop that feels pretty bullish and pretty optimistic, but you did have those mega cap names that were down. They weren't just lagging, they were actually down and weighing on the index.
Yeah, I think coming into the year, the Mag 7 peaked at 40+% of the S&P 500 in terms of weight.
Yep, back in November, it was at a high.
Yeah. So you don't get to be 42% of the index without being enormous, and it's market cap weighted, float adjusted. It's not a perfect correlation, but it's a huge part of people's portfolios. That's just the math of it.
I have a fun stat for you on that. If you look at the number of mutual fund holders on average in the Mag 7, there are 8,000 mutual fund holders in the Mag 7. And that compares to the S&P 1500, which has a little over 1,100 on average mutual fund holders. So
Multiples.
multiples, just how many people, how many institutions are in these names. And so again, it makes sense that people weren't feeling so good. And the clients that we speak to weren't feeling super optimistic, given that a lot of them have big weights in those names.
Yeah, over the last couple of years, in this world of bifurcation, where it was really this small handful of names holding up the S&P 500 and basically the only game in town, you were pushed into a lot of these names. So it makes sense that while we've been all hoping for better economic data and better earnings out of not just a few names, it still felt pretty painful.
100%. And just in terms of how painful it ended up being in the quarter for those Mag 7 names, on average, Mag 7 stocks were down 12%. Every single one of them ended underperforming the S&P 500. You had NVIDIA, which was the best performing of the Mag 7 last quarter, and that one was down 6.5%. And then you had Microsoft, which was down almost 24%. So it was a painful quarter for those names. Certainly the Doomsday blog post had a big impact in terms of freaking out investors, and then the private credit fears. There were a lot of things all happening at once that really caused these to take a hit, and they really did continue to lag throughout the quarter, not just early on when those initial reports came out.
Yeah, if I recall from your quarterly recap, large cap growth ended up being the worst performing US size and style in the quarter.
That is correct. Large cap growth was the worst, and that is rare over the last decade.
I was going to say you had a table in there of, I don't know if it was the last decade. Is that what it was? Almost
a decade. And large growth, except for the first quarter of this year, 2026, and 2022, where it was also the worst performer. Aside from those 2 years, it has been in the top box out of all the size and style boxes every other year. So certainly this is not something that people are accustomed to seeing at all. Large growth was down over 8% in this quarter, and small value was the best box, up 3.8%. And that's something we haven't seen very much of over the last several years.
I couldn't tell you the last time small value was the place to be. So it's pretty impressive. I remember that page in your recap, and that was a pretty stunning illustration of just how concentrated market outperformance has been in that large cap growth, Mag 7, secular AI trade, which kind of crumbled a bit because of news, private credit fears, and this rotation all in this quarter.
Yeah, and we haven't even yet talked about the conflict and what that did to the market, which feels like that's as far back as I can remember. Everything else that happened before that seems like it was such a long time ago. It's hard to believe that here we are, April 2nd, which, by the way, is the 1-year anniversary of Liberation Day. So just thought I would point that out. But this whole conflict started in March. That was the first trading days of that. So it hasn't been very long this has been going on, but it feels like that really is what took over the quarter as far as the main themes. And so I'd love to get into that a little bit as far as what we've seen since we got that news about the Iran attacks. And I would say, even though we are in a backdrop now where small value for the quarter was the best performer and large growth was the worst performer for the quarter, we did see that broadening story pare back a bit since the conflict started. So in aggregate, we still saw a market that was much broader this quarter than what we've seen in recent years, but the conflict did kind of pare back the broadening to a sense. In aggregate, we still are doing well in terms of broadening this quarter, but not as much as we had been earlier. And so what you saw this quarter is oil prices obviously spiked. That's what everyone's been watching. If you look back at the last several decades, this was the strongest start to the year for oil price returns in many decades. At one point, we saw oil prices up over 100% year to date. So obviously huge moves there. And with that, we saw a bit of a deterioration in that breadth story. Certainly oil prices rising oil prices is not good for most stocks. And we've seen that it's become a one variable market is the way that we're talking about what happened in this quarter, is that everybody was focused entirely on oil prices, how the conflict was influencing that. And oil prices and the S&P 500 basically were trading tick for tick together with a negative correlation of nearly 80% at one point. But all became about oil, and oil prices, if you line oil prices up with rates, they also were trading nearly tick for tick. What we saw once this conflict started is that oil spiked, rates went up, those are two things that over the last several years, investors have become hyper-focused on since COVID. We've been so focused on inflation since that 2022 inflation shock. And so markets have been, again, trading basically just on that one factor. And with that, we saw some pain under the surface in the market this quarter. If we look back from when the conflict started to the low, which was March 30th at this point, low in the market, we saw that S&P 1500, for example, 78% of stocks were down 10% or more, 48% of stocks were down 20% or more, and about 25% of stocks were down 30% or more. A lot of pain under the surface, and overall, all size and style boxes through that period were down. All sectors were down, with the exception of energy. And so certainly there had been a lot of pain in the markets. Just that shock in oil was what really stole the show as far as we like to say we went from broadening to Brent. I think that really does sum up how that quarter evolved.
So really a tale of two markets. You had that broadening where we've finally started seeing your kind of average stock do well, which is typically a great backdrop for active managers, to a one variable market where we're laser focused on the political news of the day and following this conflict, which kind of came at a horrible, it's always a horrible time, but a really bad time behaviorally because we're so laser focused on inflation and the ramifications of inflation for rates and all of these things that fuel the economy in an acceleration cycle.
Yeah, I think that sums it up beautifully. I also thought it was really interesting, just talking about global markets for a moment, that prior to the Iran conflict, you saw globally the S&P 500 and other U.S. markets were really lagging in terms of their global peers, and it was really emerging markets that were surging and be at the top of the performance list. And then since the conflict, we've seen a complete reversal in that. We've really seen S&P 500, NASDAQ near the top of the pack as far as holding up better than many other regions. And so in many places, you really did see a complete flip in terms of performance once that conflict poured some cold water on the story.
That's wild, Emily. It's pretty crazy how much things have changed in this quarter. And even day to day, just look at this week and how quickly things went from jubilance on Tuesday and Wednesday to here today, Thursday. Who knows where it's going to close? So very informative. Thanks for running through these things. But before we run, what are your thoughts on the quarter ahead? We just talked about the quarter behind, the quarter ahead. Do we go back to broadening? What are your views and how do you see things? I know there's a ton of uncertainty, but where's your mind at in terms of market outlook today?
Yeah, so that's the million-dollar question. And I would say that our base case is that we do ultimately get back to the broadening story, similar to what we saw earlier this year. There's a lot of unknowns, to your point. As we've seen, headlines can really come out of nowhere and really influence the markets day to day. But I think that what we've seen so far is the move in oil. Obviously, we've seen this oil shock, big spike in prices. I think one thing that's helpful longer term for getting back to the broadening story is that we've really seen oil prices rise for the front month futures, but not so much for the longer duration. There's basically a $30 gap at this point between 1 month oil futures and 9 month oil futures. And so we've seen, for the most part, markets have traded more closely with those longer dated futures. And so if we're able to get to a point where this is a more short-lived shock in oil prices, but we're able to get down to more reasonable levels and stay there, that certainly helps us get back to the broadening story. And then also, I think it's worth pointing out that the economy is in a pretty good spot here in the US where we can withstand higher oil prices. We are energy independent. We're less sensitive to oil swings. And we also came into this year with, we call it a lot of low oil stimulus already. Oil prices were very low and very accommodating. And so there was some room for them to move higher without being super problematic. And so ultimately, the faster we get a resolution and the faster that we get more to a more normal supply story, the better this will end as far as getting back to the broadening story. But our base case is that optimistically that we will get some sort of resolution and that we will be able to return to the broadening story. And so we are not drastically adjusting any of our preferences for this year. Certainly, we were not coming into this year being, even though we were expecting more of a cyclical broadening story, we were not anticipating another 2021 where things are just rip roaring and where mega PE expansion. We were expecting more of a moderate cyclical recovery. And so we're not swinging for the fences on our preferences in terms of risk profile. And so given where we came into the year, we don't really see any need to adjust here because we could certainly get back to more of a moderate cyclical upswing, even despite what's been going on with oil prices.
Great. Thanks so much for your time, Emily.
Thank you.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.